Hello and welcome to Talking Technicals. On the show today, we will look at some interesting chart patterns, and if spotted correctly, these patterns can help you make a lot of money. And our show expert, Dr. C.K. Narayan, will of course help us identify these formations and more importantly, learn how to trade them. Now, many of you referred to the head and shoulders pattern during the decline of the Nifty to the sub 5300 levels last month. Now, for those of you who are new to the head and shoulders pattern, it's quite simply a reversal pattern that sets up a stock for a fall after a long rise. So it has a first high which marks the left shoulder, as you can see on your graph there, then a higher top which marks the peak depicting the head, and finally this peak is once again not sustained and the weakness takes the stock down, and there's a final push that takes the stock higher which is marked as the right shoulder. And when this fails and the prices break through the neckline, so the neckline is a line which is formed by joining the lows of the left shoulder and the head. So when that neckline is broken, the stock is set for a fall. Now, as we all know, the Nifty in June showed sort of a head and shoulders formation, but actually it did not see a fall after this pattern formation. So Doc, why was that?
See, outside of all the other outside of the area of technical analysis, I think among the most widely known item is the head and shoulder pattern. It's almost sounding like a sort of yogic asana or something, the head and shoulder asana type. If you take a look at the chart, you will actually find that, the head and shoulder which you have here is something which has happened off the top. You see the rise from the, let's say the February low to the high sometime in April, and then again down to the June low, etc., which actually created the head and shoulder pattern, or what looked like one. Here is your left shoulder, here's the head, and here is the right shoulder, and here's the neckline, as we call it. Now, what you need to notice here is that this is off the high. A head and shoulder pattern is supposed to form near the top because it's a reversal pattern of the top. You can't have a head and shoulder forming at a lower level when you are in the process of a decline. This is not where a pattern is supposed to form. Which is why, even though this looks like a head and shoulder pattern, it's really not one. It is just a picture which looks like one, which is why the implications of the pattern never happen.
Never happened that time around. Okay, so let's try and understand when it actually works. So you have this rise, you have the left shoulder, you have the head, and you have the next the right shoulder, yep, and then it goes down.
Right.
Can you actually predict and use this for trades?
Yeah, very much so. In fact, here if you look at it, here you have, I'm showing you a chart of APIL, which is ALSTOM projects. And then I have actually marked out within the move itself in this sort of bluish line how the head and shoulder pattern actually forms. Now look at the left side, that's your left shoulder. This is at the head of an advance, so this is where the pattern should be seen at the end of a top. And then you have the rise to the head, and then you have a fall. Now the pattern is actually deemed to be complete when it moves through the neckline. See, that is where the neckline is. The neckline is the line which joins the two shoulders, right? So it's more or less like a horizontal line. When prices trade through it, which is where you have your trade signal, and very typically most of the patterns have something like a target implication, right? So what you do is measure the height of the head from your neckline, and then you project the same thing downward from where it breaks down. So the resolution past the neckline is from where you measure the target, and as you can see on this chart, your the trend of the stock went right down till it met where you had the target zone. So this is almost like a very perfect, this is like a textbook situation of a.
So what, in terms of percentages, how much would it be? You see it breaks the neckline, and you know that you can short the stock, basically sell it, and it'll go down maybe say 30% of the peak. Is there a ballpark number?
No, I don't think you can quite measure it that way. Any pattern for that matter, head and shoulders or any other pattern within technical parameters, the target is decided by the size of the pattern. The smaller the size, the smaller the subsequent move. The larger the size, the larger the subsequent move.
And what about the time horizon over which this pattern develops?
There really isn't any thing which is with respect to the time. What is generally stated is that the pattern formation should not take too long. Now, what is too long? That is a little bit relative, and it's not really laid down. I think among the entire set of patterns that we have, the triangle is the only one which has a certain limitations from the perspective of time.
Now, obviously, sometimes you see the neckline break and you've seen a recovery after that. So, obviously, that means it's a failed pattern. How do you figure out, like we've done with many of our indicators before, like the moving average, convergence, divergence line giving false signals.
Yeah.
Can you get false signals from the head and shoulder pattern as well?
Well, the false signal is when, there is a false breakout from your setup. Like what I'm showing you here in this particular chart. This is a chart of ANSAL INFRA, and here you again see at the end of an advance what looks like a clear-cut head and shoulder pattern, right, with a neckline. And then here, if you notice, there is a small break out of this whole setup. So this is like a valid breakdown from the pattern. So this is like a pattern completion. Now, since you have this neckline, the neckline is a line of demarcation which must not be regained or crossed over. So every pattern will have such a line of demarcation which should not be regained. What it means is that once the pattern is finished, once it is completed, stock has no business getting back within the pattern once again. If it, like in this case, it actually gets back above the neckline area and then persists within that area. So it's actually trading back, if you notice here, within the area which is defined by the original pattern. This is what is not allowed, and this is how we know that the signal is wrong, and therefore this pattern will not work out with its implications.
And if you had initiated a trade the moment it broke the neckline,
you should close it out.
You just close it out. The moment you see it go above the neckline again.
Yes, yes.
Okay, head and shoulders is one reversal pattern that we've looked at. There's another one which is called the double top. And in fact, in concept, it's very similar to the head and shoulders. Here, the uptrend, once again, these reversal patterns always come at the end of a long uptrend in a stock price chart. So what happens here is that it reaches a top, and that top is followed by a decline. You'd have a decline of, say, 10 to 20%, and the stock then tries to climb back again from those declines to make a second top, which actually is made usually on weaker volumes. And so a reversal from there, from the second top, along with break of the support line, is a setup for the stock to fall once again. So that's the second one. You have two double tops. Let's see how it works around the chart stock.
If you think in terms of a double top, what it actually has done is, instead of the head and shoulder where you had one top which was away from the rest, in the other one what you have is two tops in the same area, like in the chart of Bombay, which is the one which I have on the screen right now for you. Here you can notice that there are two tops in and around the same area, right? The double top need not actually be an exact one, but what you want is the second top to be made in and around the same area. But you will have this sort of situation in many let's say many shares. But what really converts this into a double top is when the prices actually fall and cross what we call as the valley between the two peaks. These are two peaks. So when it breaks the valley area, like it does out here, this is when this whole structure becomes a pattern. And since you have two tops in and around the same area, this is known as a double top price pattern. And the double top price pattern, you may always get a double resistance. See, a double resistance is not necessarily a double top pattern.
That's important actually to differentiate between double resistance and double top.
Absolutely, because you will
How
get you will get double resistances many times. But what is the key thing is the pattern implications are not relevant to those. It is just two resistances at around the same level. The pattern implication comes on only when it actually becomes a pattern, and that is when it falls through the low of the valley, and which is when you take the height of the pattern, like you have on this let's say on the same chart here. You will try and measure the height from the peak. Let's actually do it here. So you have this as your height, and then you take it from the point of let's see, this is the point of resolution, right, where it breaks down. And if you project that thing down on the thing, you see where the shares went. It's almost an exact replica of what happened above the line. So as above, so below. That is the logic with most of the patterns.
Right. Here's a small question for you to ponder about when we go into a short break. And this is a bearish reversal pattern. What does it indicate? Does it indicate a stock is set to rise? That's option A. B, a stock is set to fall. And C, a stock is set to move sideways. So three options about what a bearish reversal pattern is. We'll tell you when we come back. We've been telling you all of this last couple of minutes, but we'll reiterate that back in a minute.